Welcome back to our channel, The Crypto Society. Today we're here to talk about simple methods to make $100 a day trading cryptocurrency as a beginner, tutorial guide. But before we get started, subscribe to our channel to never miss a crypto update. So without any further delay, let's get started quickly. There are many ways to profit from digital currency transactions. A trading strategy helps to integrate relevant skills into a coherent and unified framework so that you have rules to follow. In this way, it's possible to continuously monitor and optimize personal digital currency trading strategies. When formulating a trading strategy, there are two main schools to consider: technical analysis, TA, and fundamental analysis, FA. We will distinguish the trading scenarios that different strategies apply to, but before studying this video in depth, please be sure to understand the differences between these concepts. There are so many types of trading strategies that it's difficult to fully describe them. We will select the most common ones for the introduction. This video mainly focuses on the trading strategy of digital currency. However, such strategies can also be applied to other financial assets, such as foreign exchange, stocks, options, or precious metals such as gold. Do you want to customize a set of trading strategies for yourself? This video will sort out the basic knowledge of speculative activities in the digital currency market. With a solid and reliable trading strategy, you will be more likely to achieve your trading and investment goals. What is a trading strategy? We define a trading strategy as a comprehensive plan that covers all trading activities. The framework created by traders can guide all trades. In addition, a careful trading plan can exclude many unnecessary decisions and help reduce financial risks. Although formulating a trading strategy is not an essential part of trading, it can sometimes save assets and avoid economic losses. If there is an unexpected situation in the current and future market, the trading plan will guide traders to take countermeasures according to different situations and avoid being dazzled by personal emotions. In other words, the development of a trading plan can prepare for a rainy day and formulate a comprehensive strategy for the possible results. It can prevent traders from making decisions that may cause huge losses in a hurry due to impulse. The transaction plan can also include other basic criteria and even some details that are easy to overlook. For example, traders can set not to trade on Fridays, or to avoid completing trades when physically and mentally exhausted and unable to think rationally. You can even create a trading schedule and set it to only trade on certain days of the week. Will you keep an eye on the price of Bitcoin during the weekend? You can choose to always close your position before the weekend. Such personalized operations can be set in the trading strategy. Developing a trading strategy can also include verification through backtesting and forward testing. For example, you can conduct simulated transactions on the Binance contract testnet. You will quickly realize that the definition of a trading strategy is not very strict, and different strategies may overlap. A hybrid approach that integrates multiple strategies is a wise investment plan. Active trading strategy. Active trading strategies require more time and effort. It is called proactive because such strategies require continuous monitoring of market dynamics and frequent investment portfolio management. Day trading. Day trading is probably the most famous active trading strategy. The public generally believes that all active traders must be day traders. This is a common misunderstanding. Day trading involves buying and selling on the same day. Therefore, the goal of day traders is to use intraday price changes, that is, price changes within a single trading day, to obtain income. The term day trading is derived from the traditional market, and trading activities are only open at specific times of the day. Therefore, day traders in traditional markets never hold positions overnight, so trading is suspended during this period. In contrast, most digital currency trading platforms are open around the clock. Therefore, in the digital currency market, the background of the use of day trading strategies is slightly different. It usually refers to a short-term trading method in which traders can complete transactions in 24 hours or less. Day traders usually use price action and technical analysis to construct trading ideas. In addition, they can also use a variety of other technical means to find market inefficiencies. Day trading of digital currencies can significantly increase the income of some people, but it usually brings great pressure, very demanding requirements, and may involve extremely high risks. Therefore, day trading is more suitable for experienced, advanced traders. Swing trading. Swing trading is a long-term trading strategy, which means holding a position for more than a day, but usually no more than a few weeks or a month. In some respects, swing trading is somewhere between day trading and trend trading. Swing traders usually actively use the volatility bands, and it takes days or weeks to show results. In the process of constructing trading ideas, swing traders may combine technical and fundamental analysis. Changes in fundamentals usually take a long time to be reflected, and this is where fundamental analysis comes into play. Even so, chart patterns and technical indicators can still play an important role in swing trading strategies. For beginners, swing trading may be the most convenient active trading strategy. Compared with day trading, the significant advantage of swing trading is that it takes a longer time to produce results. But this process is not long enough to cause difficulty in tracking swing trading. In this way, traders have more time to think about whether the decision is wise. In most cases, they have plenty of time to deal with changes in transactions. In swing trading, the decision does not have to be rushed, and it will be more rational. Day trading usually requires investors to make decisive decisions and execute them quickly. It may be difficult for beginners to adapt to this fast-paced trading activity. Trend trading. Trend trading is sometimes called position trading. This strategy is aimed at holding positions for a longer period, usually not less than a few months. As the name suggests, trend traders may use directional trends to gain profits. Trend traders may buy long positions in an uptrend and short positions in a downtrend. Trend traders usually use fundamental analysis, but this is not always the case. Even so, the fundamental analysis still considers events that may take a long time to be resolved, and this is the change that trend traders are trying to take advantage of. The trend trading strategy assumes that the underlying assets will continue to change in the direction of the trend. However, trend traders must be alert to the possibility of trend reversals. Therefore, they can also incorporate moving averages, trend lines, and other technical indicators into their trading strategies, and strive to increase the success rate of transactions and reduce financial risks. Ultra-short trading. Ultra-short-term trading, commonly known as scalping, is currently one of the fastest trading strategies. Ultra-short-term trading will not take advantage of large changes or long-lasting trends. The focus of this strategy is to repeatedly take advantage of small changes in the market. For example, profit from bid-ask spreads, liquidity gaps, or other inefficiencies in the market. The core idea of ultra-short-term trading is to avoid holding positions for a long time. It is common for ultra-short-term traders to open and close positions in just a few seconds. Because of this, ultra-short-term trading is often associated with high-frequency trading, or HFT. If the trader finds that market inefficiencies are recurring and profitable, ultra-short-term trading is a very lucrative strategy. Every time an inefficiency occurs, a meager profit can be made. These profits accumulate over time and will eventually become a considerable gain. In a market with high liquidity, buying and selling transactions are relatively stable and predictable, and ultra-short-term transactions can usually obtain ideal returns. Ultra-short-term trading is an advanced trading strategy, which is more complicated and is not recommended for beginners. This kind of trading strategy also requires a deep understanding of market mechanisms. In addition, ultra-short-term trading is more suitable for large traders, or giant whales. Since its target profit margin is usually small, trading large positions is more valuable. Passive investment strategy. The passive investment strategy reduces the degree of difficulty, and the time and effort involved in managing the investment portfolio are significantly reduced. Although there are differences between trading strategies and investment strategies, the ultimate goal of trading is to obtain income through buying and selling assets. Buy and hold. Buy and hold is a passive investment strategy. Traders can buy assets that they plan to hold for a long time, regardless of market volatility. This strategy is usually used for long-term investment portfolios. The approach is to enter the market without considering the timing. The core idea of this strategy is that as long as the investment cycle is long enough, the timing or price of the market entry is irrelevant. Buy and hold strategies almost usually use fundamental analysis and generally do not pay attention to technical indicators. When implementing this strategy, there is no need to monitor the performance of the investment portfolio frequently, just pay attention to it once in a while. Although Bitcoin and digital currencies have only been around for more than 10 years, the long-term hold, or HODL, imagination created by them is very comparable to the buy and hold strategy. However, digital currencies are extremely risky, and it is a volatile asset class. Although buying and holding Bitcoin is a well-known strategy in the digital currency field, this strategy may not apply to other digital currencies. Index investment. Index investment usually means buying trading open-end index funds, or EFTs, and index funds in the traditional market. However, such products also exist in the digital currency market, which is involved in centralized digital currency trading platforms and decentralized finance, or DeFi, trading activities. So, that's all for today's video. Thanks for watching the video. If you enjoyed it, make sure you hit like and subscribe to our channel. Let us know your thoughts in the comments section.